Hello traders, Gary Wagner here, just about 11:15 in Honolulu, 4:15 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the third day of March 2017, and this is the Daily Report for gold and silver, our weekend review. And what a week we have seen in this market. Gold under tremendous pressure yesterday, selling off in double digits, only to actually trade lower today, but recovering as we went into the close. Of course, statements made by Janet Yellen were actually supportive of gold and U.S. equities markets. We'll definitely want to touch on that as we pull up our studies and charts. But first to net price changes. As I said, under pressure today, gold traded to an intraday low of about 12.23. It traded to a high today of 12.36.70 and closed at 12.35.30. We are still long our position, but if you recall from when we initiated that position, we did recommend reserving capital to add to that position on a dip. Well, traders, we certainly have that dip. We will look to add to that position Monday or Tuesday, and of course, we'll send out a special trade alert notifying you of that fact. Silver also trading higher on the day. But still below $18. We're looking at spot silver at $17.94. When we go over to COMEX futures, $17.98, and that's actually up about 23 cents or 1.33%. Tremendous move down yesterday in silver, I believe almost 4%, and they got about 1.5% of that back. Absolutely no doubt, a quite interesting week, filled with a lot of turbulence in terms of precious metals pricing, especially yesterday, considering a market move took it down about $17. Now, the market's trading roughly closed at $17.35, up a couple of dollars. But the key to me is the low that it made today, coming down to about $12.23. Now, I've got two basic fib retracements. One of the retracements starts, as we talked about yesterday, from the beginning of the rally, December and January, taking it all the way up to these highs at $12.64. I also have another fib retracement, which starts from $11.79, moving up to the same price point. And as you can see, we've got different hash marks for different fib levels. And what we always tend to want to look at is what we call Fibonacci harmonics. And Fibonacci harmonics, in the way that I define them, because I define them in a unique way, is in which you're using two different time sequences, meaning different starting points and price points, but you're coming up with critical key numbers at the same price point. So 38% retracement, 1232, 23% retracement, 1231.50. There's a fib harmonic, okay? Now, we also have a minor level right at a 1222. This is a 50% retracement of this shorter move, and I previously had not had this in the chart, but I did receive an email this morning from one of our subscribers that does share his opinions and ideas with me, and mentioned the fact that he had this number in his fib retracements, and I did not. Of course, I stand corrected. I did not have it highlighted, but it was part and parcel of the fib retracement, this shorter one. But nonetheless, I want to thank that subscriber. He knows who he is. But based upon that, when we take a look at this particular level, I believe that that could have been the lows that we'll see in the market. We pretty much have washed out all the selling. We'll have to see if we get some sort of a recovery. But as I said, I was looking for different price points to hold. The 23% retracement, 1230, obviously did not. This for now, 1222, a 50% retracement that has held. And what I believe ultimately must hold, as I talked about yesterday, is 1210. Now, we currently have stops at 1216. We are currently long this market. We are long above this particular price point. But if you recall, when we put the trade on, I spoke about the fact that we want to reserve capital to buy on a dip. Well, traders, we certainly got that. And we're going to take this recent price decline, and because of the way we set this trade up, use it as an opportunity for us rather than it putting us under pressure. So, for today, maintain your current long position, maintain your current stop, look to add to that position early next week, and that will be notified by text message and email trade alerts. And traders, although I believe that we could have found some real support and should see prices at least stabilize next week, go sideways or higher, I do want to make you aware of a candlestick pattern that could be telling us that we have actually reached some sort of a short-term top. When we look at our weekly candlestick chart, without a question of a doubt, the pattern that we are looking at is simply called an engulfing bearish. It's opened at the close of the prior week. It is closed below the close of the prior week. Now, you would never take this call in terms of a straight candlestick pattern without getting a confirming candle. Now, a confirming candle would mean that next week's candle would be a red candle. That candle would contain a lower high, and it would also contain a lower low. It would look something like this. That would be absolutely foreboding. If that was the case and it took us to that 1210 or so area, that's actually a sell signal, but my sense is that we should have found some support, but it is something that is in the charts, and I thought we need to at least point that out. Now, the dollar, which has been really so strong, actually closed lower on the day, closing off almost 0.8%, almost a full percent at 101.37. Now, in other markets that we follow, the Dow Jones Industrial Average managed to fractionally trade higher today, closing at 21,005. What is most impressive to me is the fact that we breached that 21,000 and were able to close above it this week. Standard & Poor's also trading higher on the day, but again, fractional changes at 2383. On a weekly basis, we are closing at record highs. On a daily basis, we're closing right at those areas, but not at the intraday highs that we have achieved. NASDAQ also, that had a small gain on the day, but that's also trading at new historical highs. To say that investors and traders as a whole have already factored or baked in a interest rate hike by the Federal Reserve this month would be an understatement. We had some dynamic pressure in the markets yesterday, not tremendous, not anything like these recent rises, but we absolutely had our first long red candle in quite some time, really since the beginning of February when we went into almost a parabolic move to the upside. Today you have that slightly unchanged day. You can see that here, and that all comes after a tremendous price gap. Look at this price void right here between 20,800 and then 21,000 there. There's absolutely a price void. However, when we convert our daily into a weekly chart so we can see how this market performed over the week, as you can see, even yesterday's move did not change the bigger picture in which we closed at a new all-time high on a weekly basis, and we closed above 21,000. That is quite impressive, to say the least. Given what we are looking at and given the economic data that's out there, I would expect firmer prices in U.S. equities over the next couple of weeks, barring some unforeseen event. And traders, just as we noted in the Dow Jones Industrial Average, the difference between viewing it from a daily perspective or a weekly perspective, the same can be said for the U.S. dollar. Now, the U.S. dollar came under tremendous pressure today, trading off about 0.75%. You can see that with this large red candle that really drove the market down almost a full percentage point. We're still trading well above our 28-day moving average. And even with this down day, once again, if we convert our daily back to a weekly chart, what we will see is even though the change was nominal, we still closed higher on the week. In other words, the market closed higher on Friday than it opened on Monday. And this after 3 solid weeks of higher closes, solid in that they're green, but if you take a look at the dynamics or the range, they have really been slight ranges. In other words, slow growth, slow moves. But that's coming after finding support and having this tremendous move when when the dollar index was trading under 100 and closed just shy of 101. That about 4 weeks ago. So traders, although we have seen some distinct market pressure on precious metals prices this week, with gold closing lower on the week, really for the first time, I believe, in about a month to 5 weeks. When we look at our daily charts, we still closed above at 1235, our 28-day simple moving average, which is an average I like to use on a daily chart to define whether we're in a bull or a bear trend. When we take a look at that particular chart, let me go ahead and pull that up very, very quickly. But what we can see is that 1228 is actually that number. So in terms of the sell-off this week, yes, it occurred, but I do not believe any major technical chart damage occurred due to this most recent fall. Also, I believe that this dip should be short-term and short-lived, and I would look for a resumption of higher pricing over next week. To that end, my recommendation is to maintain our current positions, our long positions, maintain our current stops, and look to cost average or add on the dip Monday or Tuesday. We will send out a special trade alert notifying you when we believe that it is the proper time to enter and to add to our current position. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for another daily update and review. Bye-bye.